Welcome to Lesson 6 of Week 13, focusing on financial reporting. This lesson covers the SF-425 Federal Financial Report and the principles of cash management for grants. Financial reporting is how you communicate your grant's financial status to the funder. The SF-425 is the standard form used to report expenditures and cash status for most federal grants. Accurate and timely financial reporting demonstrates proper stewardship of grant funds. Late or inaccurate reports can trigger compliance concerns and affect future funding. Cash management is closely related to financial reporting. How you draw down federal funds, how long you hold them before disbursement, and how you handle any interest earned all have specific requirements. Proper cash management prevents compliance problems and supports accurate reporting. Note that form versions may be updated over time. This lesson discusses the SF-425 as it currently exists. Verify that you are using current forms when completing your actual reports. By the end of this lesson, you will understand the purpose and structure of the Federal Financial Report, key data elements, and how to complete them accurately, cash management requirements, and common reporting problems to avoid. The Federal Financial Report serves multiple purposes in grant accountability. Understanding these purposes helps you complete reports accurately. Accountability demonstrates how grant funds were used during the reporting period. The FFR shows how much was received, how much was spent, and how spending relates to the approved budget. This accountability assures the funder that their investment is being managed properly. Status tracking shows the current financial position of your grant, how much of the award has been spent, how much remains available, what is the current cash position. Status information helps both you and the funder understand where the grant stands financially. Compliance verification enables funder oversight of grant finances. By reviewing FFRs, funders can identify unusual patterns, excessive cash holdings, or other issues that might warrant attention. Regular reporting creates opportunities for oversight and early problem detection. Closeout preparation uses final reports to support grant closeout. The final FFR documents total expenditures and reconciles to the total award amount. This report is essential for closing out the grant officially and determining any final adjustments. The reporting schedule determines when federal financial reports are due. Meeting deadlines is essential for compliance. Quarterly reports are commonly required for many federal grants. These reports cover each calendar or fiscal quarter and are typically due 30 days after the quarter ends. Quarterly reporting provides regular updates on financial status. Annual reports are due at the end of each budget period, typically within 90 days after the budget period ends. Annual reports provide comprehensive financial information for the completed year. They may be required in addition to or instead of quarterly reports depending on your award. Final reports are due within a specified number of days after your project period ends, typically 90 to 120 days. The final FFR documents total expenditures for the entire grant and is required for closeout. Late final reports can delay closeout and affect future funding. Your NOA specifies your exact schedule. Reporting frequencies and deadlines vary across funders and programs. Check your specific award documents to confirm when your reports are due. Do not assume your schedule matches other grants. The SF-425 has a defined structure with specific sections. Understanding this structure helps you complete the form accurately. Header information identifies the grant and reporting period. This includes your grant number, recipient organization name, reporting period dates, and whether this is a quarterly, annual, or final report. Accurate header information ensures your report is properly matched to your award. Federal cash sections track cash received and disbursed. You report cumulative cash received from the federal agency, cumulative disbursements made from those funds, and the balance of federal cash on hand. Cash reporting enables monitoring of whether you are holding excessive federal funds. Federal expenditure sections report amounts spent in various categories. You typically report total federal expenditures for the reporting period and cumulatively. Some reports also require breakdown by budget category or other classifications. Expenditure data should reconcile to your accounting records. Recipient share sections apply if cost sharing is required. You report the recipient's contribution, both for the current period and cumulatively. Cost sharing must be documented and verifiable just like federal expenditures. Understanding accounting basis is important for accurate reporting. Cash and accrual basis can produce different numbers for the same transactions. Cash basis reports when cash is actually received and paid. Under cash basis, an expenditure is reported when the check is written or payment is made, not when the obligation is incurred. Cash basis is simpler and matches bank statements. Accrual basis reports when obligations are incurred, regardless of when cash changes hands. Under accrual basis, an expenditure might be reported when goods are received, even if payment occurs later. Accrual basis better matches economic activity to time periods. Federal preference for the FFR cash section generally uses cash basis. The cash section tracks actual cash received and disbursed. Other sections may use accrual basis depending on instructions. Check the specific instructions for your report. Consistency is required in your reporting method. Once you adopt an accounting basis, use it consistently throughout the grant. Switching methods mid-grant creates confusion and comparability problems. If you are uncertain which method to use, consult your sponsored programs office. Drawing down funds is the process of requesting federal money for your grant. Understanding this process ensures you have funds when needed while complying with requirements. Payment management systems are federal systems for requesting grant funds. Different agencies use different systems. You request funds through the applicable system, and funds are transferred to your organization. Know which system applies to your grant and how to use it. Advance payments request funds before making disbursements. You receive federal funds in anticipation of upcoming expenditures. Advances must be timed so that funds are disbursed within a reasonable period, typically within 30 days. Holding advances for extended periods violates cash management rules. Reimbursement requests funds after incurring expenditures. You spend organizational funds first, then request reimbursement from the federal agency. Reimbursement is safer from a compliance perspective since you never hold excess federal cash, but it requires organizational cash flow to cover costs until reimbursement arrives. Timing requirements minimize time between receiving federal funds and disbursing them. 2 CFR 200 limits how long you can hold advance payments. Drawing down funds far in advance of need is prohibited. Request funds only as needed for immediate disbursement. Cash on hand requirements limit how much federal money you can hold and for how long. These requirements prevent grant funds from sitting idle. Minimize holdings is the basic principle. Federal funds should be drawn down and disbursed, not accumulated in your accounts. Large cash balances suggest you are drawing funds faster than needed or not spending as planned. Monitor your cash on hand and reduce it when excessive. Immediate needs should guide your drawdowns. Request funds only for expenditures you expect to make in the near term. Most guidance suggests disbursing advances within 30 days. If you cannot articulate specific near-term needs, you probably should not be drawing the funds yet. Interest-bearing accounts are required for certain advances. Organizations that receive aggregate advances of more than $1 million per year must maintain those funds in interest-bearing accounts unless certain exceptions apply. This requirement captures the time value of money while funds are held. Interest remittance means interest earned on federal funds may need to be returned. Interest earned on federal advances generally belongs to the federal government, though a small administrative allowance may be retained. Track interest earned on federal funds and understand your remittance obligations. Expenditures are typically reported and tracked by category. Understanding these categories supports accurate reporting and budget management. Personnel includes salaries and wages charged to the grant. This is often the largest expenditure category. Personnel costs should align with effort certifications and approved budgets. Report actual personnel expenditures for the period. Fringe benefits are the associated benefit costs for grant-funded personnel. Benefits typically include health insurance, retirement contributions, payroll taxes, and similar costs. Fringe is usually calculated as a percentage of salaries or based on actual costs. Other direct costs encompass supplies, travel, equipment, contractual services, and other expenses directly attributable to the grant. These costs are specifically identifiable to your project. Report each category according to the form requirements and your approved budget structure. Indirect costs, also called facilities and administrative costs, represent organizational overhead allocated to the grant. Indirect costs are calculated using an approved rate applied to an approved base. Report indirect costs consistent with your negotiated rate agreement and award terms. Reconciliation ensures that reported data matches underlying records. This process protects accuracy and supports audit readiness. Accounting records are the source of truth for expenditure data. Your general ledger, grant accounts, and detailed transaction records should support every number on your FFR. Start with accounting data when preparing reports. Report accuracy requires that FFR data matches accounting records. The amounts you report should reconcile exactly to your books. If your accounting system shows $100,000 in personnel expenditures, that is what you report. Discrepancies between reports and records are serious problems. Variance investigation is required when differences exist. If your draft report does not match accounting records, investigate before submitting. Find and correct errors. Understand and document any legitimate timing differences. Do not submit reports that you know do not match your records. Documentation of reconciliations should be retained for audit. Auditors may ask to see how reported amounts were derived from accounting records. Reconciliation work papers that trace from records to reports demonstrate accurate reporting practices. Cost sharing must be tracked and reported with the same rigor as federal expenditures. This is not soft money that escapes scrutiny. Required contributions are matching funds specified in your award. If your NOA requires you to provide matching funds, you must deliver and document those contributions. Failure to provide required cost sharing can result in proportional reduction of the federal award. Tracking systems should provide separate accounting for cost sharing. Just as federal expenditures are tracked in restricted accounts, cost sharing should be tracked in a way that enables reporting and verification. You must be able to demonstrate what you contributed. Documentation standards for cost sharing match those for federal expenditures. Cost sharing must be verifiable from organizational records. The value must be determined according to applicable principles. Documentation should show what was contributed, how it was valued, and that it met applicable requirements. Reporting requirements include cost sharing information on the FFR. The recipient share section captures your contributions for the reporting period and cumulatively. Accurate cost-sharing reporting demonstrates that you met your matching obligations. Common errors in financial reporting undermine accuracy and create compliance problems. Awareness of these errors helps you avoid them. Calculation mistakes include arithmetic errors in totals, cumulative amounts, and derived figures. Even simple addition errors can cascade through a report. Double-check calculations before submission. Use spreadsheets or tools that calculate automatically. Timing errors place expenditures in the wrong reporting period. An expense incurred in one quarter but reported in another distorts both periods. Understand the reporting period covered and ensure expenses are properly allocated to the period in which they were incurred or paid, depending on your accounting basis. Category misclassification puts expenses in the wrong budget category. Travel expenses reported as supplies or personnel costs reported as contractual misrepresent how funds were used. Ensure each expense is reported in the correct category, matching your approved budget. Inconsistent prior reports mean current reports contradict earlier submissions. Cumulative amounts should build logically from period to period. If you reported 50,000 cumulative expenditures last quarter and 80,000 this quarter, your current period expenditures should be 30,000. Inconsistencies suggest errors in current or prior reports. Report certification is a formal attestation that the report is accurate and compliant. This certification carries weight and responsibility. Authorized official means reports must be signed by someone with authority to certify on behalf of your organization. This is typically the authorized organizational representative or a designated financial official. Unauthorized signatures do not meet certification requirements. The certification statement that accompanies your signature attests that the information is accurate, that expenditures are proper and in accordance with grant terms, and that required cost sharing has been or will be provided. Read and understand what you are certifying before you sign. Responsibility means the signer has personal accountability for report content. This is not merely a formality. False certification can have consequences. Signers should have reasonable basis for believing the report is accurate and should not sign blindly. Verification before signing requires reviewing reports carefully before certifying. Check that totals are correct, that data matches accounting records, and that nothing appears inconsistent or unusual. If you have questions or concerns, investigate before signing. Late reports create problems and should be avoided through good planning. Understanding consequences motivates timely reporting. Consequences of late reports can include withheld payments until reports are submitted, negative effects on future funding decisions, and compliance concerns that may trigger additional oversight. Chronic late reporting suggests management problems. Extension requests should be made before deadlines pass. If you anticipate being unable to meet a deadline, ask your program officer or grants management specialist for an extension in advance. Advance requests are generally viewed more favorably than after-the-fact excuses. Communication with the funder should occur promptly if delays are unavoidable. If you will miss a deadline, notify the funder rather than simply not submitting. Explain the situation and provide a realistic, revised timeline. Communication demonstrates responsibility even when problems occur. Prevention through building report preparation into your regular schedule avoids last-minute crises. Know your reporting deadlines, begin preparation in advance, and complete reports with time for review before submission. Systematic scheduling prevents most late reporting. The final financial report is a comprehensive summary of your grant's financial activity. This report is essential for proper grant closeout. Comprehensive summary means the final FFR covers the entire grant period, not just the final reporting period. This report provides the complete financial picture of how the award was used from beginning to end. Cumulative totals show total expenditures across all periods. The final report documents what was spent in each category and in total. These cumulative amounts should reconcile to the award amount, accounting for any carryover, supplements, or returned funds. Unliquidated obligations are costs incurred but not yet paid at the project end. These may need resolution before closeout. Understand what obligations remain outstanding and have plans to liquidate them or adjust the final report accordingly. Closeout timing requires the final FFR within a specified period after the project ends, typically 90 to 120 days. This deadline is firm. Late final reports delay grant closeout and can affect your ability to receive future awards. Prioritize final report preparation as project end approaches. Let us summarize the key points from this lesson on financial reporting. Accurate financial reporting demonstrates proper stewardship of grant funds. The SF-425 Federal Financial Report communicates your grant's financial status to the funder. Accurate reports show that you are managing funds responsibly. Inaccurate or late reports raise concerns about your grant management capabilities. Essential practices include timely submission meeting all deadlines, data reconciled to accounting records, and proper certification by authorized officials. Build report preparation into your regular schedule. Verify accuracy before submitting. Treat deadlines as firm obligations. Cash management principles require minimizing federal cash on hand and drawing funds only for immediate disbursement needs. Do not accumulate federal funds in your accounts. Deposit advances in interest-bearing accounts when required. Remit interest as applicable. In our next lesson, we cover performance reporting, which documents your programmatic progress against grant objectives. Financial and performance reporting together provide the complete picture of grant accountability. Practice exercise. Obtain a copy of the SF-425 and review each section. If you have access to a grant, prepare a mock FFR using actual accounting data. Verify that your mock report reconciles to accounting records and meets all reporting requirements.